Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 3, this is Section C, and this is an application topic. Calculate the amount to be recognized for contributions, and that would be financial assets and non-financial assets, to a non-governmental, not-for-profit entity. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free, it is 1 hour, and we will teach you the key ingredients to passing the CPA exam so that you don't waste months or even years of your time. After you watch that, you're going to want to learn more, so make sure you check out becoming a Superfast CPA Pro member, because Pro members not only get access to the big ticket item, which is the Pro course, where Nate explains exactly in detail exactly what you're supposed to be doing every day, but also Superfast CPA Pro members get access to the full 10-question versions of these videos that I make, where I only post a 5-question version on YouTube, but again, Pro members get access to the full 10-question version. So if you like this and you like our other products, if you become a Pro member, just remember you'll get access to the full 10-question versions of these videos, and you'll get a little bit more learning and a little bit more understanding. With all that, let's go ahead and dive into the questions. Okay, here we are at question 1, and something we always like to point out right at the beginning is you always want to read the last part of the question first when you are doing multiple choice questions. It doesn't always work, but this is a strategy that will be helpful on test day. This is something you want to get used to doing, because if you read the last part of the question first, that's usually the actual question, like it's the thing you're actually supposed to be doing. So reading that first gives you context for the rest of the question so that as you're reading through the question, you actually know what you're supposed to be doing and you actually know what you're supposed to be looking for, instead of getting to the very end of the question and then finally realizing, oh, this is what I was supposed to be doing. That's why we read the last part of the question first. So let's read that. What amount should the organization recognize as total contribution revenue for the year? Okay, let's go up to the top. A non-governmental, not-for-profit organization received the following contributions during the year: a cash donation of $50,000, equipment with a fair value of $30,000 donated for use in a new program launching next year, a cash donation of $20,000 restricted to funding scholarships, and artwork valued at $40,000 donated for display in the organization's public gallery. So again, with all that information, with all of these, what is the amount of total contribution revenue that they're going to recognize? Now, if you have any idea how this works, then you might have a good idea of what the correct answer is. But if you have no idea what this is, or you've had a little bit of experience with not-for-profit entities, then we're going to use this answer to learn what we're supposed to be doing. Again, we're using these questions to teach us what we're supposed to know. So if you want, go ahead and pause the video, but if not, let's go ahead and look at the answer together. Okay, here we are. The answer is D, $140,000, or all of it is going to be counted as contribution revenue. So let's walk through this. This is something that I honestly don't think that I understood as well as I should have for the CPA exams. Luckily, I was still able to pass, but I really wanted to hit this concept home a lot throughout this video. So I want to make sure that it's clear as we go through this. All 4 contributions are unconditional and are recognized as contribution revenue, regardless of whether restrictions are imposed on their use. So we're going to talk about what unconditional means, and we're also going to talk about restrictions because they are not the same thing. If that was ever confusing to you, conditional, unconditional is not the same thing as restricted or not restricted. So let's dive into that. Unconditional contributions are those where the donor imposes no requirements or conditions that must be filled before the contribution can be used or received. Restrictions, on the other hand, specify how or when the contribution is to be used, but do not prevent immediate recognition as revenue. So let me just say that one more time. I'm going to read it through this to kind of hit that home again. Restrictions are distinct from conditions. Restrictions affect use, while conditions must be met for recognition. Unconditional contributions, whether restricted or not, are recognized as revenue in the period they are received. So I'm just going to say that one more time, and then we're going to talk about these, and we're going to talk about it throughout the rest of the video too. If a donation is given, and there's no condition placed on the donation where they're saying, hey, you have to do this to be able to even get this money or to be able to keep this money, then that would be a condition. If there's no condition, then it would be unconditional. That is not the same thing as restrictions. You know, you may have seen in other videos or in other topics that there are donations that are with donor restriction and without donor restriction. That's different than conditional and unconditional. With donor restriction means that the funds don't have a condition on them, like you don't have to do anything to get the funds, but you do have to use the funds in a certain way, but they're not going to take away the funds if you don't meet the condition or whatever the case may be. And without restriction means you can use the funds for whatever you want. Again, there's a difference between conditional and unconditional and restricted and not restricted. Okay, now that we've talked about that a whole bunch already, let's talk about these different donations and then we'll move on through the rest of the video. The cash donation of $50,000 does not mention any restrictions or conditions, so it is recognized as contribution revenue and would technically, by the way, be revenue without donor restriction because it didn't have any restrictions on it. The equipment donation of $30,000 is restricted for future use because it was for a certain project, but it is unconditional, so it is recognized as contribution revenue as well, and it would be revenue with donor restriction. So you see that distinction. It's unconditional, but it can still be with donor restriction. The $20,000 cash donation for scholarships is restricted but unconditional, so it is recognized as contribution revenue as well. The artwork donation of $40,000 is restricted. It's supposed to be displayed specifically, but it is unconditional, so it is recognized as contribution revenue. So again, we're going to talk about this throughout the whole video. Conditional, unconditional, not the same as restricted, not restricted. So all that added up together is $140,000. I feel like I've hit that home a lot already in just one question, so I'll move on. We're going to go to the next question. All right, here we are at question 2. What amount should the foundation recognize as contribution revenue for the year? Let's go up to the top. The Harmony Arts Foundation, a non-governmental not-for-profit organization, received the following donations during the year. A donor provided $75,000 in cash, restricted to funding a new youth arts program. The donation was accompanied by a letter specifying the purpose, but imposed no further conditions. A local business donated $100,000 to the foundation, contingent upon the foundation organizing and completing a new annual arts festival within the next calendar year. Okay, so with all that information, again, we have to figure out how much contribution revenue they're going to recognize. Based on all the stuff I talked about in the previous question, I bet you could figure out a lot of this. So pause the video, come back when you're ready, and we will talk about it together. All right, here we are. The answer is B, $75,000. Let's walk through this. Contribution revenue is recognized only for unconditional contributions or pledges. Again, I'm just going to say that one more time. Unconditional. Regardless of whether there are restrictions on their use. Conditional donations are not recognized until the conditions are met. Here's the breakdown. The cash donation of $75,000 is restricted, so they were given the money. It's supposed to be used for the youth arts program, but it's unconditional. They were given the money. They weren't told, hey, if you don't do this, you don't get to keep the money. They were just asked, hey, can you please use this money for this specific youth arts program? So it is recognized as contribution revenue. The $100,000 donation is conditional on organizing and completing an arts festival. Since the condition has not yet been met, this is not recognized as revenue for the current year. What does that mean? We're going to talk about it in just a second. But overall, the only amount of contribution revenue that they can recognize is the $75,000. They cannot recognize that $100,000 donation, and we're going to dive into that in just a second here. One more thing I want to talk about is restrictions. I just wanted to say a little bit more about restrictions. Restrictions specify how a donation must be used, but do not affect recognition as contribution revenue if the contribution is unconditional. Conditional donations, however, require specific events or actions to occur before they can be recognized. In this scenario, the $100,000 donation is conditional and cannot be recognized until the condition is fulfilled. Since the $100,000 has already been received, like they already were given $100,000 as a donation, this is actually accounted for as a liability called a refundable advance because they may have to give the money back if the condition is not met. So basically, they were given this $100,000 and they were told, you can keep this $100,000 if you organize this arts festival within the next calendar year. So that implies that if they don't organize that arts festival within the next calendar year, they have to give back that $100,000 of donation, meaning it's a conditional donation. And because they have the chance that they're going to have to refund it, that they're going to have to give it back, this is not counted as contribution revenue, but is rather counted as a refundable advance. So that was another aspect of this. Now let's go to the next question. All right, here we are at question 3. What is the appropriate journal entry for the pledge at year end? The Bright Futures Foundation, a non-governmental not-for-profit organization, received the following pledge during the year. A major donor pledged $500,000 to the foundation contingent upon the foundation opening a new community center within the next 2 years. By year end, the foundation has made significant progress on the project but had not yet opened the center. So again, with this $500,000 pledge, what is the appropriate journal entry for the pledge at year end? So think about this. We've talked about unconditional contributions. We've talked about conditional contributions. This is a pledge. Is that different? Think about this, and when you're ready to come back, we will look at the answer together. All right, here we are. The answer is C. No journal entry is required. This is kind of the easiest thing that we've talked about so far. A conditional promise or a conditional pledge to give is not recognized in the financial statements until the condition has been substantially met. In this case, the pledge is contingent upon opening a new community center. Since the condition has not been met by year end, no receivable or revenue is recognized. So this is different than a conditional donation. A conditional donation means they've already been given money, but there's a condition that they have to meet to be able to keep the money. So that's why you account for it as a refundable advance. But if it's a conditional pledge, meaning they're saying, hey, we will give you this money if you do this thing, then there's nothing that you have to account for because you haven't received any money. There's no guarantee of you getting that money because you still have to complete the thing that they're asking you to. So there's no receivable. So you just don't recognize any revenue when there's a conditional pledge or promise. Not the same thing as a conditional donation. Conditional pledge or promise, you don't have a journal entry. All right, let's go to the next question. Okay, here we are at question 4. What amount should the foundation recognize as contribution revenue for the year? Let's go up to the top. The Bright Horizons Foundation, a non-governmental not-for-profit organization, received the following during the year. A donor gave $50,000 in cash. A corporate sponsor pledged $200,000 to the foundation, stating the funds would be paid in equal installments over the next 4 years to support the foundation's operations. The pledge included no additional conditions or restrictions, and the sponsor has a reliable history of fulfilling its commitments. And finally, a community organization donated $75,000 in cash, restricted to funding a specific community outreach program. So with all that and everything we've learned so far, what is the contribution revenue that they're going to recognize from all of these? This is throwing in one more thing that we haven't talked about. So pause the video, think through this, think through what we've learned so far, and when you're ready, come back, we will look at the answer together. All right, here we are. The answer is D, $325,000. So let's walk through this. Contribution revenue includes all unconditional contributions and promises, and we did mention this before, but we hadn't really seen it yet as far as unconditional promises, whether they're restricted or not. So the $50,000 cash donation is unrestricted and unconditional, so they can use it for whatever they want, and they don't have to meet any conditions to keep it, so it's recognized as contribution revenue, and it would technically be without donor restriction. But again, that's not the same thing as what we've been talking about throughout this, which is conditional and unconditional. The $200,000 pledge is an unconditional promise to give, meaning the foundation has a right to receive the funds without meeting any conditions. Even though the payments will be made over 4 years, the entire $200,000 is recognized as contribution revenue in the current year. And that is how it works. If you are given an unconditional pledge, meaning they are saying, hey, we're going to give you money. There's no condition for us giving it to you. We're just going to give it to you. You haven't received the money from them yet, but there is a pledge that they're going to give you the money. You can recognize that as revenue. And no matter when you're actually going to receive the money, you recognize the money as revenue in the year that you receive that unconditional pledge. So that's different than a conditional pledge, where at the conditional pledge, you don't report anything. An unconditional pledge, you do report it as revenue. There might be an allowance for doubtful accounts depending on, the situation where you're like, I don't think we're actually going to receive all of that money, so that might be something you see. But overall, just know that unconditional pledges / promises, you do record them as revenue. The $75,000 cash donation is restricted but unconditional, so it is recognized as contribution revenue. So all of it, the $50,000 plus the $75,000 plus the $200,000, so that's $325,000, is going to be recognized as contribution revenue. And I'm just going to say it one more time. I already explained this, but I'm going to read the last part here. Unconditional promises to give are recognized as contribution revenue in the period they are made, even if the cash is received in future periods. Restrictions on the use of contributions do not delay revenue recognition, but only affect how the funds are reported in net assets. You would debit pledges receivable for this $200,000 pledge, and by the way, you would credit revenue with donor restriction. Again, that's not something we're diving super deep into in this video because we've talked about it in other videos, and I just wanted to mainly focus on conditional and unconditional, but this would be a credit to revenue with donor restriction because they're saying they're going to give you the money, so you can recognize the revenue, and it's because it's unconditional, but you haven't actually received that money, so you can't use the money, so that's why it's with donor restriction, because you need to restrict that money so you don't use it because you haven't actually gotten the money yet. So that's how that works. But anyway, now let's go to the next question. All right, here we are at question 5. What amount should the foundation recognize as contribution revenue for this transaction? Again, very similar throughout this whole video, but we're learning different parts. The Generous Hearts Foundation, a non-governmental not-for-profit organization, held a fundraising gala where attendees made donations and received benefits in return. The following transaction occurred during the year. A local philanthropist donated $25,000 to the foundation and received a table at the gala valued at $5,000, as well as a framed thank you photo worth $500. So with all that information, what is the amount of contribution revenue they're going to recognize? This is different than what we've talked about so far, but it's also not that difficult. So pause the video, think through this, give it a good guess, and when you're ready, come back, we will look at it together. All right, here we are. The answer is A, $19,500. So this is pretty easy. You just need to know how it works. Contribution revenue is calculated as the difference between the total donation and the fair market value of goods or services received by the donor. Here's the calculation. So that's $25,000 donation. They had a total of $5,500 of fair market value of benefits. So that was the $5,000 table and the $500 photo. So the $25,000 donation less the $5,500 of benefits is $19,500. And that is the amount of contribution revenue in this case. When a donation includes goods or services provided to the donor, the fair market value of those goods or services must be subtracted from the total donation to determine the contribution revenue. Only the portion of the donation exceeding the FMV of the benefits is treated as contribution revenue. So if you're receiving something in return for a donation, when it comes to the organization, they can only recognize contribution revenue for the donation that, you didn't receive anything for. It's just actual donation, like the true donation. So that's how that works with that piece of contribution revenue. And we've gone over a lot in just 5 questions. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 3, 4 questions trying to teach you how an unconditional donation works, or how a conditional donation works, or whatever the case may be. You're going to notice these things popping up in the questions. These are the things you see frequently and constantly. And so you take a moment, you write these down as pillar topics, kind of, a summary of the most important things you learned in your own words. And as you're doing this each day, you are going to be building the pillar topics, the most important things you're supposed to know for the exam so that you are prepared for the exam on test day. So with all that, let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just dive in. First off, unconditional contributions. Unconditional contributions are recognized as revenue immediately and classified as either with or without donor restriction, depending on the donor's intent. But again, that's not the same thing as unconditional and conditional. With or without donor restriction is a separate thing. Now let's talk about conditional contributions. Conditional contributions are not recognized as revenue until the conditions are met. Any funds received before meeting the conditions are recorded as a refundable advance liability. Again, because they're saying, hey, we'll give you this money, and they give you the money, but then they say, to keep that money, you have to do this thing. You have to meet this condition. So that money could be lost. That you might have to give that money back if you don't meet the condition. So that's why it's recorded as a refundable advance until the condition is actually met. Now for conditional promises to give are not accounted for until the specified conditions are substantially met, at which point they are recognized as revenue. So, at that point, it would be changed from a conditional promise to unconditional revenue because they've met the conditions. So now there's no more conditions and they can recognize the revenue. But before that, they haven't received any money and there's a condition they have to meet. You don't record conditional promises in the financials until you've actually met the condition, and then, you go after that. Now for unconditional promises to give are recognized as revenue in the period the promise is made and classified as with donor restriction unless specified as unrestricted. But usually it will be counted as with donor restriction because, again, they're saying they're going to give you the money and there's no condition for them giving you the money, so you can recognize it as revenue, but you haven't actually gotten the money yet, so you can't actually spend it yet, so it's with donor restriction. And then finally, this is the last thing we covered, donations given in exchange for something. When donors receive something of value in return for their donation, the fair market value of the goods or services received can be classified as sales revenue, and we might talk about that with the members in the pro version of the video. And the remaining amount is recognized as contribution revenue. So overall, if you give a donation but you get something in return, the contribution revenue is actually going to be the difference between the donation and the fair market value of the things that you received in return. Only the amount over the fair market value is going to be counted as an actual donation and actual contribution revenue. And with all that, we've gone over a lot in just 5 questions, and that is it. That's the end of this video. Before you go, make sure you check out our free 1-hour webinar training. Again, go to SuperfastCPA.com, sign up for that, and we will teach you the key ingredients to passing the CPA exam. And after you watch that, you're going to want to learn more, so make sure you check out becoming a SuperfastCPA Pro member, because again, Pro members get access to the Pro course, where Nate teaches how to do this whole process step by step in detail. It's super helpful. And Pro members also get access to the full 10-question versions of these videos where I only make 5 questions on YouTube. But again, Pro members get the 10-question version where they can get more practice and a little bit more understanding. So with all that, I hope you liked the video. Make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.